Hey everybody, it's Jelani Taters here. So a couple years back, I wanted to try to get a financial investing YouTube channel going. We had a bunch of other different content as well, so it was like super random. But I was really getting into finances and investing, and I started putting out a bunch of these YouTube videos that was just kind of explaining what I know or was finding out at the time, but also attempting to teach it. And I realized that there wasn't that much that I actually knew, so there wasn't that much that I could really present. So I decided to take a break from that and maybe take a few years to actually learn how to do a little bit more and have some more experiences. And that's what I've been doing for the past few years. So I guess you could say I'm trying to relaunch a financial YouTube channel. And assuming that I continue to do it regularly, which is the plan as of right now, it's going to be sort of half teaching, half just explaining my experiences and the things that I found out. So this video is going to discover a couple different basic things like general style, my thoughts on diversification and volatility, and basically just kind of give an idea of a starting point and hopefully make things a little bit easier for you if you are planning on starting investing or starting to get really serious about your financial situation in 2022. Maybe just some general pointers and an idea of where to start. Again, this is not investment or financial advice at all. This is just relating my experiences and talking about some things that I personally think are good to do and that have personally worked for me. So first off, when we're talking about investing and finances, the first thing that I would go to is trying to eliminate debt. That's a huge one. Honestly, if you have debt, then that just hangs a weight over your head, and it's a lot more important to get rid of that debt versus trying to pick stocks or cryptocurrencies or whatever it is that you might be wanting to do. So I think first and foremost, the biggest thing is get rid of debt and be on some type of budget, whether that's a Dave Ramsey zero-based budget or whatever helps you to be able to pay your bills and be able to handle your finances. That's the most important thing. Once it comes to actually growing that amount of money, that can be done in a bunch of different ways. That could be done by getting a raise at your job, finding a new and better job, putting in more hours at your job. It could be done through any type of side hustle, whether it's YouTube or day trading or long-term investing or whatever. There's a million different things that work for different people. Me personally, one of the biggest things that's helped is just starting to index in my 401k. So I'm fortunate enough that at my job I have a match on my 401k, and then I just index it all. And even though you'll hear me talking a lot about stock picking, that's something that I'm really interested in and something that I really like to do and want to continue to do more and more over time. There's nothing wrong with just indexing, buying a S&P 500 index through Vanguard or Fidelity or whatever it might be, and you're basically just buying everything, and you're just tracking the index of one of the major indices like Dow Jones or NASDAQ or S&P 500. And that works great. That's still where most of my net worth is, so there's absolutely nothing wrong with that. However, getting into more of the specifics of investing, let's start with style. So me personally, I don't have anything against day trading or anything like that. For me, it did not work. I was somewhat interested in it years ago, and I tried to do a little bit of it actually with Forex, foreign exchange currencies, and it just did not work for me. And I found it to be too spastic, and the way that I look at it is it's basically fairly sophisticated gambling. And now some people have figured out how to play blackjack consistently and do really well. I actually, for several months there, I was playing slots at casinos consistently and winning. So there are ways of doing it. I'm not saying it's impossible or wrong or anything, but it is fundamentally different from investing. So just be aware of that. When it comes to actually investing, basically how I describe investing is buying something for less than it's worth. Because if you're wanting to buy and resell a car or a stock or a house or whatever it is, the idea is that it's worth this amount. You shop on the cheap and buy it for this amount, and that way you don't have to hope that it'll rise in value. It's already worth that amount. You just got it for cheaper. And I guess another way of presenting that is that if you were buying a really growthy company, a company that had a lot of built-in levers to expand over time, think something like a Tesla or something like that, it may not currently be worth that much. It may or may not. I'm not specifically talking about Tesla now, just using it as an example. But a growthy company may or may not be worth that much at that moment. But the idea is that they have a game plan for getting to that amount of value over time. And so you're still buying something for less than you think it's worth, be that what you think it's worth in the present or in the future. So a couple different ways of doing that is your very fundamental value investing, like Warren Buffett, Ben Graham. They actually do have some very fundamental differences, as where Ben Graham would typically buy things very, very cheap metrically, and he would buy it in a basket, 20, 30, 40, maybe 50 stocks at a time. And he would typically be using metrics like price to earnings, price to book, and just try to get a big array of companies for absolutely as cheap as possible. And his main goal was actually trying to get them that were trading on the market discounted to the amount of cash that they had on their books. So ideally, in his mind, if you bought a basket of these and he bought them all on the market for less than the cash that they had, they would either be liquidated and he would receive that amount of cash as a shareholder, or people would start to realize how ridiculously priced they were and they would go back up in price on the market. And he found out over time that if you have a basket of these, like I said, 20, 30, 40, over the course of a year or two, you tended to actually do really well. And I want to say he ended up having a lifetime track record of something like 15%, doing mostly that. So that is something that definitely can work, still does work to this day. I myself, it didn't work that great for me. And I've only been doing this for a few years, so maybe I just haven't given it enough time. But for me personally, I didn't really enjoy trying to find a basket of 20, 30, 40 of these. And there are some other potential complications, like for instance, a lot of these really, really cheap companies that are selling for less than cash are probably not going to be in the US most of the time. And maybe that's just me not looking hard enough, but a lot of them you'd find outside the US, very obscure, over-the-counter stocks. Nothing wrong with that, but you have to take into consideration a lot of brokerages charge international fees. They charge over-the-counter fees. So if you're wanting to get a whole basket of these, you more likely than not will be paying extra fees in order to assemble an array of these. Also, the second problem that I had with them is that I figured, okay, well, if I'm already indexing this large portion of my net worth, if I'm actually going to be stock picking, then let me actually stock pick instead of just creating another basket of stocks like an index. It just seemed to me to be overdoing the whole index concept. It's like, if I'm actually going to be stock picking, then I'm going to go in and find the best businesses that I can. And these businesses that Ben Graham in his idea of investing, they're just fundamentally not good. That's why they're selling for so cheap, is because they're not typically good businesses. So again, that works really well for some people, buying a basket of businesses that are selling on the market for less than cash, but it wasn't really for me. Now, Warren Buffett started out doing a lot of that, and that worked very, very well for him. And then over the years, he transitioned to more of a growth at a reasonable price. And going back to that example that I said earlier, he would buy something based maybe more off of future projections than exactly what it was worth today. And he's a good enough security analyst that he's right most of the time when he is making these projections about the future of a business, how much cash flow they're going to be making, what their earnings are going to be. He's very good at doing that, and he's had a lot of success over the years. It's gotten a little bit more difficult for him lately just because of the size of money that he has, and I think he's probably at this point in his life more worried about preservation of that capital instead of growing. But yeah, that worked really well for him for a long time. Now, moving on to something that's even a little bit more specific, and this is actually where I've gravitated to, is focusing on maybe one of either of the last two scenarios where you're buying something for less than cash or you're buying something based off of future projections. But the idea with what I'm going to be talking about right now, which is generally referred to as special situations investing. The idea is that whatever company you're buying has a specific event that's attached to it. We normally refer to it as a catalyst. And the catalyst could be a bunch of different things. It could be an activist shareholder going in, buying up shares, and then calling the shots and making management do their job better. It could be one company buying out another company. It could be a company spinning off or making an IPO, raising funds for an IPO. It could be any different number of things, but it always is described as having some sort of event attached to it. So with this, you are pretty much equally focused on the fundamentals of the business, what they're making in earnings, in cash flow, and the general cheapness of it. But you're putting equal weight onto a specific event that is happening. So like one area that I've actually had a lot of success in it's called tender offers. So you have tender offers and arbitrage. Generally, how arbitrage works in the stock market, we normally refer to it as merger arbitrage. Company A decides to buy out Company B. Let's say Company B is selling for $10 a share. Company A says, we want to buy you for $11 a share. So ideally, if you can get into that company at $10 and then you get offered the $11, then you've instantly made a 10% return, which is great. But it gets a little bit more complicated than that because everybody knows about this. And generally by the time you yourself hear about this arbitrage deal, it's already been bid up to its buyout price. Now, if you really specialize in this area, you'll find these different situations where there's some huge problem. Maybe it's not that huge a problem, but there's some kind of problem that is preventing the price from being bid up, even though everyone knows about it, even though it's been recognized. There's some problem preventing it from being bid up to its offer price. Maybe people aren't sure about how likely the deal is to go through. It could be any number of things. But if you're very familiar with doing merger arbitrage and it's something that you're experienced in and knowledgeable in, those can be different situations that you watch out for. And basically, you are just counting on you being more knowledgeable and doing more due diligence that you can buy this company at its $10 or $10.50, even when everyone else is afraid to. And ideally, the merger does end up going through, and you get that final payout. So tender offers are somewhat similar, but the difference between arbitrage and tender offers are primarily in that tender offers are the offers made directly to the shareholder of the company versus made to the company overall. So for instance, I could be sitting here with a stock that is selling for $10. Again, let's just use that example. And another company comes along and personally sends me an offer, not to the entire company, but just to me for my shares. A lot of times, because of how that works, you'll actually have the same company buying you, their own shareholder, out at a premium price. Now this can get really interesting because it's a lot more obscure than standard arbitrage, and a lot of times they have what's called a lockup feature. So with arbitrage, you're typically you're just waiting for the price to be bid up after you've bought into it, more or less. That's what's going on. With a tender offer, you can actually call your broker and tender the shares, and they will be locked in at that final offer price. So using the example of the $10 to $11, I don't have to buy it and hope or wish that it rises to that offer price. It is actually locked in, and I've literally already made that 10% as long as the deal goes through. And it's just about that easy. It's actually extremely intuitive. Of course, as with everything else, there are things that can go wrong. It's still something that you have to be careful about, do your own due diligence, but I myself have done really well with these historically. You can track them. If you go to Google Alerts, you can set stock tender offers or Dutch tender offers, and it'll tell you about every new tender offer that comes along. And then you can use a number of different brokerages to do them. I myself used Fidelity for a long time, and they do the lockup feature for free, which is really good. But recently I've been having some troubles with them, just different discrepancies, changing the rules a little bit. Last time they told me that I had to have a certain amount of cash free in order to participate in a tender offer, things like that. So I'm still trying to get all that figured out and haven't done a tender offer for a while because of those complications. But for about a year there, I was doing at least one tender offer a month and making anywhere between 3% and 20% return inside of a month or two for each one, which is actually that's outrageous. Those are really, really good returns. The other thing about tender offers is that they really cater to people that have small amounts of money, because you are going to get preference by having a lesser amount of shares. Basically, when someone is doing a tender offer, what they're trying to do is they're really trying to buy out small shareholders. So it is actually advantageous to not have a lot of money if you're trying to participate in these. So that is a place that I would typically recommend to get started if you're trying to get into stock picking, because it's typically fairly low risk, and you do have things such as the lockup feature, and it's a really good way to use small amounts of money to learn about how to pick stocks, to learn about fundamentals, to do your due diligence, to learn about arbitrage. I consider that a really great starting point if you can find a brokerage that is willing to do all those things without charging you fees. Another area that I've had some pretty good success with is spin-offs. So a spin-off is done when you have a company and it has multiple subsidiaries, and they decide that they're going to make one of their own subsidiaries public, and they basically hand off that percentage of their business straight to shareholders as a part of a new business. And it can get kind of complicated, but because it's complicated, therein lies some of the opportunity. That's another area that I've had some pretty good success with. There's a couple different companies that I'm inside of right now that are actually planning on doing these spin-offs. So you have IDT Core. That's one that is actually my largest single position right now, and they are planning on doing multiple spin-offs of different divisions of theirs. And that's actually sort of their model, is they basically buy small niche tech businesses, they build them out to profitability, and then they spin them off into their own business. And typically what happens is when a business goes from private to public, there is what's called a liquidity premium that's put on it. And that basically just means it's considered more valuable simply due to the fact that you're able to buy and sell at the click of a button, which is the coolest part about any stock, is that it has that liquidity. So I've gone through quite a bit about different styles and some of the different things that have worked for me, and something that I'll definitely be talking about more in different videos. Since this video is starting to get pretty long, I'm actually going to go ahead and cut it right here, and then I'll get into some of the other things in the next video, talk about diversification, volatility, and things like that. But I think this is going to be all for now. Hopefully I'll be doing this semi-frequently, semi-regularly. We'll see how it works out. It's all an experiment. But at the very least, it was really nice being able to put my thoughts out there and being able to talk about this stuff, because it really excites me. So good luck. Have a great year of finances and investing in 2022. And be safe out there. Have a good one.